The Intelligent Investor, with over 10 million copies sold worldwide, is hailed as the Bible of investing. Why does it remain a guiding light for ordinary people to succeed in the market? First published in 1949 by Benjamin Graham, this classic inspired Warren Buffett and is called a must-read 3 times for every investor. From Wall Street's chaos to everyday family finances, it reveals investing's essence with plain language and profound wisdom. It's not about speculation but finding certainty in uncertainty through reason and discipline. Today, let's explore Graham's world and discover why this book, over 70 years later, still lights the path to financial freedom. Section 1. Graham and his era: The Roots of Wisdom. To understand The Intelligent Investor, we must first know its creator, Benjamin Graham. Born in London in 1894, he moved to America as a child, facing dramatic shifts from wealth to poverty. His father's early death and family's financial ruin taught him life's unpredictability. After graduating from Columbia University, he joined Wall Street as a bond analyst but nearly went bankrupt in the 1929 crash. This financial disaster not only wiped out fortunes but shaped Graham's investment philosophy. He realized market booms and busts weren't random but amplified by human greed and fear. The Great Depression's lessons drove Graham to question how to protect wealth in a risky market. He rejected chasing quick profits, focusing instead on a company's intrinsic value to develop a rational approach. In 1934, with David Dodd, he wrote Security Analysis, laying the foundation for value investing. The Intelligent Investor popularized this theory for everyday investors, stressing discipline, patience, and a margin of safety. Graham's wisdom wasn't innate, it was forged from failure. His rigorous, almost conservative personality infused the book with a unique tone. He loved mathematical formulas for investment logic yet approached markets with awe. He famously said, "The secret of investing is to buy stocks as if you're buying a company." This reflects his rational mindset and deep understanding of human flaws. In an era of rampant speculation, he was a calm philosopher, using logic to counter market noise. The era's context matters too. Early 20th century America saw industrialization and urbanization, with the stock market as a stage for wealth dreams and traps. 1929 crash shattered confidence, leaving investors wary. Graham wrote The Intelligent Investor during post-World War II recovery, as markets warmed but speculation persisted. He aimed to give ordinary people a timeless framework to avoid past mistakes. Graham's life and times shaped his unique perspective. Not a born financial genius, he built value investing through observation, reflection, and practice. His student Warren Buffett recalled feeling struck by treasure reading the book, as it revealed both methods and market truths. Graham's insights, rooted in human nature and market dynamics, remain timeless. Section 2. Core Principles: The 4 Pillars of Value Investing. The Intelligent Investor centers on value investing, distilled into 4 key: intrinsic value, margin of safety, Mr. Market, and long-term thinking. These are the bedrock of investing and reflect Graham's deep market insights. 1. Intrinsic value. Buy companies, not stocks. Graham believed a stock's true worth lies not in its market price but in the company's economic strength. He wrote, "In the short run, the market is a voting machine. In the long run, it's a weighing machine. Market emotions may inflate or deflate prices, but a company's profits, assets, and management ultimately determine value." Like Warren Buffett's 1988 investment in Coca-Cola. Despite market dips, Buffett saw its brand, global network, and steady cash flow as a moat. He bought 7% of the company for $1.3 billion. Today, it's worth over $20 billion. Buffett, following Graham, treated stocks as ownership, not gambling chips. For everyday investors, assessing intrinsic value is achievable. Graham advised checking price-to-earnings ratios, balance sheets, and dividend histories. In the 1960s, General Electric's steady earnings and low valuation made it a value investor favorite. Graham urged finding stocks priced below their worth, like discounted quality goods in a store, requiring patience and research. Intrinsic value demands independent thinking. Graham warned that trendy stocks are often overpriced, driven by speculative crowds. In the 1970s, U.S. tech stocks soared on innovation hype but crashed, costing investors dearly. Graham's lesson: true value lies in overlooked corners, uncovered by reason. Margin of safety, the shield against risk. The margin of safety, Graham's proudest concept, means buying assets far below their intrinsic value to cushion against uncertainty. He likened it to an engineer building a bridge to bear far more weight than needed. Investors should buy stocks at a steep discount to weather surprises. Charlie Munger, Buffett's partner, exemplified this in the 1970s. He invested in blue-chip stamps, priced well below its asset value, earning multiples even in a downturn. Graham advised buying stocks at least a third below their value for wiggle room if estimates are off. This principle applies beyond stocks to bonds and real estate. During the 2008 crisis, savvy investors bought undervalued U.S. properties, reaping rewards as prices recovered. Graham's genius was embedding risk management in every decision. The margin of safety is also a mindset. Graham saw overestimating value as the biggest risk, not market swings. He urged assuming lower future earnings or discounted assets in analysis. This conservative approach acts like insurance, ensuring survival in worst-case scenarios. 3. Mr. Market, the test of emotions. Graham's vivid Mr. Market personifies the market's irrational swings. Each day, Mr. Market offers prices sometimes wildly high, sometimes depressingly low. Graham advised ignoring his short-term moods, buying only when prices are low and selling when high. Peter Lynch, of Fidelity's Magellan Fund, lived this principle. In 1990's market panic, he bought Walmart cheaply, later earning huge returns as it dominated retail. Lynch said, "Mr. Market is emotional. Your job is to exploit his madness, not follow it." This metaphor guides not just pros but anyone facing life's ups and downs. Like market swings, life has highs and lows. Staying rational is key. Graham turned complex investment psychology into relatable wisdom. Mr. Market also teaches focusing on long-term trends, not short-term noise. In the 2000 dot-com bubble, tech stocks soared, but Graham's followers avoided them as prices far exceeded value. When the bubble burst, those who ignored Mr. Market's hype escaped unscathed, unlike trend chasers. Long-term thinking, the magic of time. Graham's final pillar is long-term thinking. He believed value investing's rewards unfold over time, as markets eventually reflect true worth. He wrote, "Time is the friend of great companies and the enemy of mediocre ones. Holding quality firms long-term yields growth and compound wealth." Buffett's career embodies this. In 1965, he bought Berkshire Hathaway, a failing textile firm, and transformed it into a diversified empire worth billions. Buffett said, "Our goal is to hold companies forever." This is Graham's essence. Long-term thinking demands patience and discipline. Graham noted many fail by chasing quick profits, ignoring market randomness. In the 1987 crash, panic sellers lost, but those holding quality stocks thrived in the next bull run. Graham likened investing to planting a tree, waiting patiently for it to bear fruit. Section 3. Practical application from theory to wealth. The intelligent investor isn't just theory, it's a practical guide. Graham divides investors into defensive and enterprising, offering tailored strategies. Let's explore how to apply his principles with real cases and actionable tips. 1. Defensive investors, prioritizing stability. Defensive investors seek capital preservation and steady returns, ideal for those with limited time or low risk tolerance. Graham suggested splitting funds evenly between stocks and bonds, adjusting dynamically in market swings. Take Eileen Carter, a U.S. homemaker. In 2010, she invested $100,000 for her kids' college, half in U.S. Treasuries, half in an S&P 500 index fund. During 2015's volatility, she raised bonds to 60%, dodging losses. By 2020, her portfolio grew to $150,000 thanks to simplicity and discipline. Graham also favored blue-chip stocks, established firms with steady profits. Johnson & Johnson, with 50 years of unbroken dividends, held strong into 2008's crisis. In China, firms like Kuaika Mutai, with strong brands, suit defensive investors. Defensive investing also involves periodic rebalancing. Graham advised checking portfolios yearly, selling stocks if they exceed 60% to buy bonds, restoring balance. This cuts risk and boosts returns by selling high and buying low. In the 2000 tech bubble, rebalancers avoided tech crash. 2. Enterprising investors, research and patience. Enterprising investors, willing to dig deeper, aim to beat market averages. Graham urged studying financials to find undervalued gems, holding them long-term. Buffett's early bet on American Express in the 1960s is a prime example. A scandal tanked its stock, but Buffett's analysis showed its core was solid. He bought low, and within years, Berkshire reaped billions. Graham's method: research value, wait for markets to correct. For everyday enterprising investors, Graham set criteria: P/E ratios below 15, low debt, and a decade of profits. In China's 2015 market dip, Gree Electric's P/E hit 8, meeting Graham's standards. Savvy buyers later saw big gains. Enterprising investors must avoid overconfidence. Graham warned of human limits. In the late 1990s, Buffett skipped Microsoft and Amazon, unfamiliar with tech. He missed short-term gains but dodged 2000's tech crash by sticking to his strengths. Being enterprising means deep focus, not reckless bets. Practical tips: investing like buying a house. To make value investing relatable, think of stocks like buying a house. In Shanghai, you'd assess a home's value, location, size, schools, not overpay due to a neighbor's bid or sell cheap in a slump. Similarly, focus on a company's fundamentals, not price swings. Here's a step-by-step plan. First, learn basics. Read annual reports for revenue, profits, and debt. Graham suggested security analysis for deeper study. Second, set goals: steady income or growth, and allocate funds accordingly. Third, diversify. Hold 10-20 stocks across industries to cut risk. Fourth, review yearly. Sell overvalued stocks, buy undervalued ones. For a Chinese investor like Miss Han, a 40-year-old with $70,000 in savings, she could put 30% in bank products, 30% in a CSI 300 index fund, and 40% in blue chips like China Ping An or China Merchants Bank. She'd review annually, tweaking holdings to stay balanced. 4. Building and managing a portfolio. Graham detailed how to craft and manage portfolios for balanced risk and reward. He urged spreading funds across asset types and industries, avoiding all eggs in one basket. In the 1960s, Graham's student Walter Schloss held over 100 undervalued stocks, ensuring stability despite some duds. Modern investors can follow these rules. Asset allocation: adjust stocks, bonds, and cash by risk tolerance. Young investors lean 70% stocks, older ones 60% bonds. Industry diversification: span consumer goods, finance, energy to dodge sector slumps. In 2008, overexposure to banks crushed some, but diversified portfolios survived. Dynamic tweaks: sell overvalued stocks, buy undervalued ones. Buffett's 2008 bet on Wells Fargo seized a bargain. Monitor quarterly or biannually, avoiding overreactions to daily swings. In China's teen crash, panic sellers lost, but disciplined reviewers won in 2017's rally. Mental discipline: mastering human flaws. Graham knew success hinges on mindset, not just methods. He stressed that investors' worst enemy is themselves. Greed, fear, and herd mentality spark bad choices. In the 2000 dot-com craze, chasers of tech stocks ignored valuations, losing fortunes when the bubble burst. Graham's followers, sticking to margins of safety, sidestepped ruin. Buffett's mantra, "Be fearful when others are greedy, greedy when others are fearful," echoes Graham's mental training. To counter flaws, Graham suggested, set rules buy only at P or E below 15, sell if 50% above value to curb emotions. Keep a journal log trade reasons and expectations, reviewing to spot errors. Munger learned from logs to ignore short-term noise. Seek outside views, discuss with rational friends or advisors to avoid bias. Buffett and Munger's partnership thrives on this. Section 4. Universal Wisdom Investing as Life. The intelligent investor transcends finance, offering life lessons. Graham's principles reason, discipline, long-term thinking apply broadly. Take Charlie Munger, not just Buffett's partner but a cross-disciplinary thinker. He used Graham's contrarian logic in life, asking, "What do I want to avoid?" This kept him from bad choices, like overhyped tech stocks. Munger said, "From Graham, I learned not just how to make money but how to think." In daily life, a margin of safety applies. Starting a business, keep a steady job as a buffer, like Graham's discounts. Mr. Market's metaphor guides handling workplace or social swings. Don't let others' moods sway you. Graham's insight into human flaws, greed, and fear as traps extends to life. Discipline and reason bring clarity in a messy world. He wrote, "The investor's chief enemy is often himself." Graham's wisdom also shines in understanding opportunity costs. Investing means choosing what to buy and what to skip. In life, picking a job may mean forgoing a startup. Family time may cost income. Weighing trade-offs rationally is Graham's gift. Section 5. Global Perspective. Value Investing's Universality. The intelligent investor works beyond America, proven worldwide. From Japan to China, Europe to India, its principles fueled wealth. Japanese investor Heiwa Takeda, in the 1980s, built Takeda Peace Industries, targeting undervalued small manufacturers. Using Graham's margin of safety, buying at book values below 1, he profited even in Japan's 1990 bubble burst. Takeda's success shows Graham's ideas thrive in varied markets. In China, fund manager Hang Kun, in the 2010s, earned over 20% annual returns on Kuaikao Mutai and Tencent. He credited the intelligent investor as his foundation, leaning on safety margins and long-term focus. In India, Rakesh Jhunjhunwala, the Indian Buffett, started in the 1990s, investing in undervalued firms like Asian Paints and ADFCA Bank. Holding long-term, he gained hundredfold returns. Jhunjhunwala wrote, "Graham taught me to find good companies and ignore price swings." These cases prove Graham's cross-cultural timelessness. No matter the market, intrinsic value, safety margins, and long-term thinking build wealth. This explains why The Intelligent Investor is translated into dozens of languages, inspiring millions globally. Section 6. Key quotes and summary. A timeless beacon. The Intelligent Investor is more than a guide, it's a beacon for wealth and life. Here are 6 of Graham's golden quotes, capturing his wisdom. The secret of investing is to buy stocks as if you're buying a company. In the short run, the market is a voting machine. In the long run, it's a weighing machine. The margin of safety is the cornerstone of investment success. Mr. Market is your best friend and worst enemy. The intelligent investor is a realist, selling to optimists and buying from pessimists. Time is the friend of great companies and the enemy of mediocre ones. This book's greatness lies in teaching not just investing but thinking. It shows wealth requires patience and wisdom demands practice. Whether you're a market novice or a life explorer, Graham's lessons guide you. In today's fast-changing world, markets grow more intricate, but Graham's wisdom shines on. Investing isn't about chasing trends, it's about finding lasting value. As Buffett wrote in the 50th anniversary preface, "This book changed my life, and it will change yours." May every reader draw strength from Graham's teachings to navigate markets and life, finding their own certainty.